Good afternoon, tech traders. Today is the 20th of January, 2024, and this is Dean Lapierre for Trading Edge Capital, and just wanted to go through a trade analysis today, a trade setup for something that I had put on Friday, and this is our old friend IBM. So IBM is setting up for an earnings announcement. It looks like that earnings announcement is on the 24th, so just 4 days from today. And as a result, you can see the volatility climbing up in anticipation of that earnings event. And we're fully expecting a vol crush after that earnings event. So different ways that we might trade that in the future. But at the moment, I'm going to be looking at, I believe, some sort of out of the money either strangles or condors or something, because that volatility is peaking up nicely here. So I'm going to be looking out at the March contracts and see what we might be able to put together. So looking at the trading package, my trading edge, here's the data on the options. We pulled in the options chain for the call deltas between 9 and 75 and the put deltas between 6 and 55. And you can see from the surface, the vol surface diagrams, that these out-of-the-money options here for both the puts and the calls are at the elevated vol. Here's the differential between the current IV, the current implied volatility, and the historical volatility, and that gap is really the edge we're playing for. So we are looking for a perhaps slightly bullish position. I don't want to get too bullish, and that's just simply because we're trading at all-time highs here for, I don't know if they're all-time highs, but they're 52-week highs for IBM, and so I don't see this having a lot of rocket potential from the upward standpoint, and the pot odds would suggest that we'd have to be a little bit more careful on the downward side. So I don't mind being a little bit bullish, particularly when we have all these positive indicators of a very bullish environment. We just hit, I believe, an all-time high with the S&P 500, so pretty bullish near-term directional bias out there. So I wouldn't mind a couple of positive deltas, but I'm really thinking that short Vega, short volatility on this, playing for that volatility crunch that we will see in a couple of days, may put us in a good position. We've traded this setup before many times with IBM, and we've traded it very well. So let's see if there's anything else that we can glean from this. We are a near-term bullish position from the directional standpoint. Out of the money options look well elevated, and good sale candidates here for the out of the money options. And we've got a pretty good coefficient of variation. In other words, the stock has behaved, in IBM-like fashion in terms of pretty steady, hasn't had a lot of wild swings. So I really like the way that this thing is setting up. So let's see if we can put a trade together here. First thing we'll do is we'll take the trade evaluation date. As you know, I'm always looking to be out of this contract about a couple of weeks, at the very latest, a couple of weeks out of expiration, which expiration is the 15th of March, and so I'm going to look to be out of this certainly by the 1st of March. So that will set up a range here for me, where between the first and second standard deviation on the put side will be between 163 and 154, and on the call side, call it between 180 and 188. So let's start off with a put strike somewhere, let's say the 160s, and see where that gets us. Those are selling, or last selling, for 157. So let's see if we sell one of those, what we get. We'll get our trade structure here, and it looks like a nice setup, right? 82% probability of profit. We do have positive expectancy, good payout ratio. The only thing that is flashing a little bit red here is the expected return on capital. That's because this is a tax-advantaged account, so we have to put up the entire value here, $15,000. So that is putting stress on my expected return on capital. The return on risk is quite good. So what I might do is look to hedge this, make it a little bit more capital efficient. So I'll look to hedge it on the downside with, let's say, the 150s, and see what that does for us. And so if we were to hedge that risk here, that will turn it into a short put spread, and you see that takes care of my expected return on capital. So I'm getting green all the way through here. So this looks like a very strong trade setting up here. with just a simple short put spread, and it looks like I could take a lot more of them if I wanted to, with only risking about $890 per vertical here. So I could just leave it at that and take a bunch more of those. But let's see if I can do something a little bit. What I don't like here is, what edge am I trading? I'm actually looking to trade a short volatility edge. So I'm looking for this short Vega down here to be the dominant Greek rather than the long delta. So right now I've got more long deltas than I have short Vegas, and I really at this point am a little bit cautious, and you got to remember what you're trading for, or what the edge is you're trading, and the edge that I'm trading is for that volatility crush. So I'm going to balance out my deltas here and probably look to take something on the upper end of this trade, which is around the 180, call it, between these two levels here. So let me see if I can balance this out. Now I'll put a vertical up here, a 180 and a 185 for a short call spread. So I'll sell the 180s and I'll buy the 185. That will balance my risk up here, and what I've done is create essentially a broken wing iron condor, and things are looking pretty good here. What I really like here is this sensitivity profile. Remember the edge you're trading for. I'm trading for a volatility crush. So here my deltas are all but neutral at 0.82, but I'm looking at 15, short 15 Vegas, and that is the trade that I want. So I like this trade quite a bit. I could take a significant amount more. Again, I could take more of these. So I could look to take, let's say, 5 contracts on the upper and the bottom side. And if I were to do that, there's that broken wing condor. That is, I'm looking at over $1,000 of income, or premium, I should say, with a very, very good trade metrics, good payout ratios, good return on capital, very strong Sharpe ratio. And again, there is that really, really heavy short Vega profile here. So 75 short Vegas, and essentially all but delta neutral. Positive theta, I've got $13 of positive theta. And so really a short Vega dominated trade here, which I like. So this one is looking like a nice setup. I will likely put this broken wing iron condor into play, and maybe look to do 5 contracts on each side, with taking a little bit more risk on the downside. But this trade has really worked out well for IBM over a period of time. We do have hedged downside here, so about $4,000 of risk, on the downside potential should this thing really, really suffer a big hit. But again, like the short, a little bit of a positive delta position here, if I was going to lean anyway. So I like that setup. I hope you found that helpful, found the analysis helpful, and that's the analysis for today. So good luck with your own trading. If there's any questions, you know where to find me at the website, or you can find me on the Discord channel. So for now, happy trading. Have a great rest of your weekend.